you have uh, a taste and an understanding of gold and an appreciation for gold as a hedge for extreme inflation, as well as an economy that's going to crap or a political or geopolitical unrest, you'll buy gold. So as yields go lower, that's supportive for Chinese buyers of gold, right? The reaction to that, which is China stimulus, is also supportive of gold outside of China. I mean, inside of China as well. But so uh, disinflation in China is stabilizing for gold, and printing in China is bullish for gold. So
Recent World Bank data reveals China's emergence as a dominant force in the global gold market, securing its position as the world's second-largest importer of non-monetary gold after Switzerland. This development, coupled with China's status as the leading global producer, underscores the nation's extraordinary demand for the precious metal. The impact of China's gold acquisition strategy has reverberated through international markets, contributing to gold's record price of $2,696 per ounce in October 2024. Market analyst Vince Lanci notes that gold's appeal extends beyond traditional investment considerations, serving as a hedge against inflation, economic instability, and geopolitical uncertainties. The combination of lower yields and China's stimulus measures has amplified domestic and international demand. China's transition to becoming the world's primary gold consumer, surpassing India, coincides with significant domestic economic challenges, particularly in its real estate sector. The property market, a preferred investment vehicle for Chinese citizens since the early 2000s following regulatory liberalization, has experienced notable deterioration. This market weakness, disappointing manufacturing data, and concerns about potential tariff increases have contributed to Chinese stocks experiencing their worst annual start in nearly a decade. Lanci identifies a notable pattern in market behavior, observing that gold prices often appreciate in anticipation of Chinese economic stimulus measures. This predictive price movement suggests traders should position the market more sophisticatedly ahead of expected policy actions. The scale of China's gold acquisitions appears aligned with a broader strategy to diversify foreign reserves and reduce risk exposure. However, despite recent substantial purchases bringing national gold holdings to 2,264 tons, the World Gold Council reports that gold comprises just 4.6% of China's total foreign reserves, indicating potential for continued acquisition activity. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
this is the gold chart on the left, and on the right is the stock market, the Hang Seng. Now, you can see the general trend: higher in gold is higher in the Hang Seng, and lower in gold, lower in the Hang Seng seems to be at least loosely correlated with lower in gold. So now it's story time. Now I'll tell you a couple things, using a couple important signposts that we all understand. This is not rocket science, but it is focused observance. On the right-hand side is the Hang Seng. On the left-hand side is gold. I have September 9th, the week of September 9th for you circled on the Hang Seng. That is the week before they announced stimulus. Now, move your eyes to the left, and gold is already starting to rocket. Okay? Gold leads the Hang Seng higher when they stimulate, because gold leads the stimulus, because traders in China know it's coming and they buy gold. All right? So on the way up, gold leads. Okay? That's your takeaway. Gold leads when expectations of China stimulus are coming back into the market. Now, today's activity in gold tells you that. Second week is the week of October 7th, which is an extremely spiky and sell-off high in stocks in China, because for whatever reason, they don't think it's enough. Plus, a lot of this upswing was a short squeeze. There were a lot of shorts in Chinese stocks then. Now, bring your eyes to the left. It doesn't affect gold. See that? Gold does not drop when the Hang Seng drops. So China stocks will follow gold higher when China looks like it's going to stimulate, and China stocks will not lead gold lower when they kind of crap out like they did here. That's the behavior that's been going on for, a couple of years, more or less, that I've been following. All right. Next chart. What about other events? All right. So now we have the week of the election. Now we go to the left. On the gold chart on the left, you have the November 4th week, which is the week of the US election. Gold makes a high and proceeds to drop for that week and the next week pretty steeply. Now, what about China? Well, the China stock market makes a high, closes on the highs, and then really craps out. So you say, well, what about the relationship there? Well, the relationship there is on the left, gold did what it did because the election was known, it was made certain. The end of the American Republic did not happen. And so people in America sold their gold. Okay. The right, China's stocks crapped out because Trump won. And Trump wins, that's tariff troubles for them. All right. So there is no correlation between China stocks and gold in this chart, in this example here. So there's nothing going on there. Now I'll spell it out for you. On December 9th, I don't remember what happened that week. I can't believe I can't remember, but I'm a little bit overwhelmed this morning. The Hang Seng spiked as well as gold did. And then after that, it sold off hard and finished a week quite weak on the week. So I would say to you that gold and stocks worked weaker on some event that happened during this week.
The Chinese equity markets experienced their most significant decline in 27 years as investors responded negatively to Beijing's limited economic intervention measures. This market reaction followed a press conference by the National Development and Reform Commission that failed to deliver anticipated additional stimulus policies beyond those announced in the previous month. The market decline reflects more profound structural challenges facing the Chinese economy as it navigates post-pandemic recovery obstacles. Official data indicates concerning economic indicators, including an urban youth unemployment rate of 18.8% and an overall urban unemployment rate of 5.3% as of August. These statistics, combined with ongoing difficulties in the property sector, underscore the complex economic environment facing Chinese policymakers. Market analyst Vince Lanci observes an intriguing divergence between Chinese equity markets and gold prices. While stock markets demonstrate weakness, gold's sustained strength suggests market participants are positioning for potential monetary stimulus measures. This dynamic illustrates gold's role as both a hedge against economic uncertainty and a beneficiary of anticipated policy responses to market stress. Let's get back to the interview.
Well, first of all, it means that China's economy, China's markets are telling you that China needs more stimulus. Okay, which is why the US stock market is up, which is why the dollar is up. This is the American exceptionalism, kicking in again, because even though it's probably a sale to sell stocks after the inauguration at some point, not today, right? So it's kind of like a bounce of a bounce of rejection. But gold is stronger, and this is quite surprising that gold is stronger coming out of the gate with China stocks lower. So it would look, I'm looking for reasons to get short gold this time of year. Okay. And I'm not finding them yet. I'm not telling you to get long, and this could be very short-lived, but observably speaking, if China stocks are weak and we know that they don't really take down gold, but gold is now up, well, then maybe the cycle is wrapping to the point where China might actually stimulate. So China's markets are telling you it needs stimulus and that they should not be backing off on this RRR thing, which is a recalibration of their reserve requirements. Anyway, so long story short is people are going to be talking about this week China, right? China has troubles. I think they do actually. It costs a lot of money to support every other economy out there, and they've actually been supporting. They're Russia's banker. They're supporting a lot of economies out there. Anyway, I want to keep watching this, right? I'm a tape watcher. So if China stocks keep dropping and gold keeps rallying, then it's on, right? But if China stocks keep dropping and gold uh, uh, dips or gold flattens out, then I know this is short-lived and it's just the end of buy season coming in. Anyway, that's the long story. Sharing it with you because that's where my analysis is right now.
China's expanding influence in the gold market highlights its strategic approach to navigating economic challenges and diversifying reserves. As domestic hurdles persist, including real estate instability and underwhelming manufacturing performance, the nation's emphasis on gold underscores its role as a stabilizing asset amid uncertainty. This interplay between economic policy and precious metals creates a compelling narrative for the global market, with China's actions shaping future gold demand and pricing trends. How do you see China's economic strategies impacting the global gold market in the future? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.